When defining your trading strategy, one important thing to think about is whether you will only take long positions, meaning that you will only trade in the upside potential of a stock or other financial asset, or if you also want to assume short positions, where you will also try to find overvalued assets and bet on its depreciation. As we already saw in the video of the previous week, that I will leave in the description below, short selling allows you to profit if some asset sees its price decreasing. To do so, you basically need to find some investor that is willing to borrow, for example, a stock that you would then sell at the market price that you believe is too much high, so that later on, when you have reached your target price, or because you must return the stock back to its owner, you would acquire the financial asset once again at the price of the moment. Remember that the idea is the same in both short and long positions. You want to buy the asset at the lowest price and sell it at the highest price. So, in this example, you would profit only if the price decreased, as it is your buying price. There are several advantages and disadvantages that you need to consider if you want to include short selling in your trading strategy. Starting with the advantages. Short selling will allow you to be more present in the market and provides you additional trading opportunities. One of the most important things to have in mind when trading is that you should trade in the same direction of the trend. And since price is evolving in cycles, meaning that they pass sequentially from uptrends to downtrends, if you assume only long positions, there can be a long period where you will have to leave the market, because there is a downtrend in place and you will be risking too much if you bet on the opposite direction. Another advantage, also related to the previous one, is that short selling allows you to trade on negative news. This is something important even to guarantee that markets are efficient, at least to a certain level. If short selling was banned at all, it would be harder to incorporate negative news in the markets, and prices could become too much high and completely disconnected from the real value of the asset. For more complex strategies, short selling is also essential to hedge against the price movement of other investments. By other words, hedging means to reduce the portfolio risk by investing into things that tend to evolve into opposite directions. And this is something particularly important to some entities, such as companies whose business is highly dependent on a certain commodity. For example, companies who extract crude oil from the underground are dependent on this commodity, where if the price of oil decreases, then the sales of the company will also decrease. So, one possible way to reduce this business volatility is to hedge at least a percentage of this exposure, for example by holding a short position in the market of oil. This way, if the price of oil decreases, the company will still see the amount of revenues decrease, but will also profit from its short position. But on the other hand, if the price of oil increases, the company will see its revenues also increase, but will now hold a loss in the short position. This means that there is a trade-off that must be weighted, and the decision will lastly depend on the managers of the company. Regarding the disadvantages, one of the most important ones is that, in theory, the losses when short selling can be unlimited. To understand this, let's first think about long positions. When you take a long position, your maximum loss will be 100%. That will happen if the price of the asset you invested reaches zero. But, on the other hand, when you take a short position, you will lose money if the price increases, since you will need to buy back the stock in the future to return to its original owner. The thing is that there is no upper limit for the price, and if it increases 200% or 300% or even more, you will have to face this loss if you haven't placed any stop loss. This makes short selling not entirely suited for beginner traders, since first you should develop your discipline and mental attitude, otherwise you can lose more than the capital you've invested. The second disadvantage is that some assets might be hard to borrow, meaning that it is difficult to find someone who is willing to lend you the asset. And this is something more significant to more illiquid stocks, where most of the short selling potential can be. The need to create a margin account can also be another disadvantage. When creating a margin account, your broker is basically setting a lower level that limits the losses of your capital invested. Meaning that if you have an unrealized loss higher than a certain percentage of the amount invested, the broker might close your trades and only allow you to trade once again after you reestablish the initial amount by adding more money into your account. Short selling also involves several additional costs that you need to support, both related to the borrowing rate that you often pay because you are borrowing the asset from other investors, and also due to the creation of a margin account that, depending on your broker, can also have a cost. As you can see, short selling involves a lot of advantages and disadvantages that you should study more deeply before choosing to include it in your trading strategy or not. Also, make sure to know your broker, namely how you should place your trades and how much commissions they charge for each class of assets. Personally, I still don't plan to use short selling because I'm just starting to trade more seriously, but in the future it might be something to consider because it also increases the array of opportunities that you have. Hope that you have learned something in this video, and if you did, don't forget to leave your like below. Also, feel free to subscribe and don't miss any new content, and I will see you in the next time.